With the gold price up nearly 19% this year against the S&P 500, which is up only around 7.5%, you're probably finding lots of headlines saying that you should be buying gold right now. These headlines have probably increased in the last month, what with the market turbulence. The US stock market, the S&P 500, is down nearly 4%, whilst the gold price this month has gone up 6%, coming close to its all-time highs. As with any investment decision, we shouldn't be looking at the short term. We should be focusing on the long term and how this investment is going to impact your long-term financial plan. After all, why would anyone invest in gold? It's not a business, it doesn't produce any income. A quick trawl through the internet and you'll find that the three most common reasons that people invest in gold are: number one, it's seen as a safe haven during times of turbulence. Number two, it's seen as a good hedge against inflation. And number three, it's seen to reduce the overall value of a portfolio. So let's explore these three reasons in more detail in this video and find out whether you should be investing in gold right now. I'm Carl Roberts and I'm a regulated financial advisor. So let's look at the first reason why people buy gold. Gold as a safe haven. And what do we mean by safe haven? Well, investors look at a safe haven as being something that will either maintain or increase the value of their investment during times of market turbulence. So if we think back through periods where there's been wars, great sort of financial crises, stock market crashes, depressions, people sometimes look to hold gold during those times because they believe gold will increase in price or at least maintain their investment, whereas stocks are significantly falling. And if we look back during the last 100 years of different recessions, we can see that you definitely would have benefited most of the time from holding gold during these recessionary periods versus stocks. If we take a recent example of a recession going back to the 2007 Great Financial Crisis, we can see that the US stock market, the S&P 500, fell about 37% during this recession, whilst gold, on the other hand, was up around 16%. So you would have done much better holding gold rather than being in the stock market. But this doesn't always happen though. There are instances, particularly in the 1980s recession, where gold actually underperformed the stock market. And the problem is, if you're thinking, okay, gold does work in recessionary times, I'll sell out of my stocks and buy gold instead, that's going to be incredibly difficult to time right. I mean, that is time in the market. And what usually happens if you track the price of gold is that once recessions have finished, which of course you will not know when that's going to happen, but once recessions technically finish, the gold price can drop quite significantly afterwards. And by that point, the stock market is already back up and producing gains. So it would be really difficult in the moment, in the eye of the storm, to pick the point at which you're going to go into gold and sell out of stocks, and then go back into stocks and sell out of gold. So I wouldn't advocate trying to hold gold just during recessionary periods. So let's look at the second reason that people invest in gold. Gold is a hedge against inflation. So many investors believe that you invest in gold, it will help your investment keep up with inflation and maintain its purchasing power. And this is really important because if your returns on cash or your investment are not beating inflation, then you're actually losing money in real terms. So if we look back over the last 100 years, then gold, yes, has definitely beaten inflation over those 100 years. But if we break down each of the last decades of the last 100 years, we can see that it's not consistently beaten inflation during each decade. We can see here that during the 50s, the 60s, the 90s and the 2020s so far, that each of these decades, gold failed to beat inflation. And in the chart on the screen right now, this is showing lots of rolling 5, 10 and 20 year periods, and shows the chances of gold and other assets beating inflation. And what's really interesting is if you look at the 20-year period, which is probably the minimum amount of time that people are going to spend in retirement, you're actually far better off with your chances against inflation by investing in the global stock market. Looking back at the past, there's almost 100% certainty that you'll beat inflation over a 20-year period if you invest in a portfolio of global stocks. Whereas there's only about a 54% chance of beating inflation over a 20-year period if you invest in gold. So on to the third and final reason that people invest in gold. Gold as a way to reduce the overall volatility of your portfolio. So what we mean here is using the approach of diversification. Diversification is a really good way to invest if you're someone that is not particularly keen on taking lots of risk or doesn't like volatility. Volatility meaning the movement of prices, the up and down, the swings, the falls, the highs of your investment. So diversification can be a good way to sort of limit or reduce that volatility because you spread your investment into lots of different assets. You might hold cash, property, investments, stocks, bonds, and then some people will also add gold to their portfolio, hoping that it reduces the overall volatility further. Interestingly though, if we look back over the last 50 years, we can see that gold has actually been more volatile than global stocks and even UK stocks. So let's look at what happens if we mix that all together. We're mixing stocks, bonds and gold. So a typical portfolio for a balanced or medium risk investor would probably be a 60-40 approach. So 60% usually in global stocks, 40% in global bonds. But if we reduce both of these proportions by 10% and we add that 10% to gold, so adding gold to the portfolio, how does that impact the overall volatility? Well, looking back over the last 10 years, that type of portfolio would have reduced volatility very minimally. So a portfolio without gold would have a volatility score of about 8.3%, whereas the portfolio with gold had a volatility score of about 8%. And obviously the lower the score, the less volatile it is. So you would have seen a bit of a reduction in volatility, but not really much, and you would have lost out on performance. So to conclude, if you're looking to hold gold to reduce volatility, then you probably will work. There will be very minimal benefit to holding some gold. It probably will reduce your volatility, particularly in times of recessions and things like that. But if you want the best overall returns, so if you're someone that's very focused on returns rather than volatility, then a portfolio of global stocks is still going to be your best option going forward over the long term. But remember, these decisions should be taken with the long-term strategic view in mind, building your financial plan first, seeing what you need to achieve to reach your goals, and then design your investment strategy. You should not be picking gold just this year or trying to time it in and out because of a recession or you think something's going wrong in the markets. Either hold gold for the long term because you're worried about the impact of volatility, or forget about gold altogether and just focus on global stocks if you're going for the best long-term return and you can cope with the levels of volatility. I hope you found this video useful. Please don't forget to subscribe so you don't miss any further videos that are coming soon.